Hey, Kelly, happy Wednesday.
Happy Wednesday. Ready to talk about best practices for tax filing?
Would love to. I'm glad you asked. My favorite thing. Um, okay, perfect. So we're gonna wait maybe 30 more seconds for people to join.
Okay.
Got a good group here though. So we'll only give it another 30 seconds. This webinar will be recorded. So totally fine. If you're coming in a bit later, just reach out to us. We're more than happy to share the recording with you if you missed part of it.
Yeah. And jump into everybody's favorite topic, which is taxes. We'll talk about some deadlines. So it should be a riveting webinar for everybody.
Yeah, that's right. If you're having trouble sleeping tonight, just crack open this webinar and I'm sure it'll put you right to sleep. Okay, great. Thanks everyone for joining today. Excited to talk to you about best practices for filing as a real estate investor. We're going to start with the basics, of course, because we have different levels here in this webinar, different levels of experience as investors. And then I promise we're going to ramp up to more and more complex things. Obviously, throughout the webinar, feel free to drop your questions into the Q&A. We'll be selecting a few of those questions at the end of the webinar to answer. If some of them are relevant in the topic that we're talking about, we might also pluck them out and answer them immediately. So without further ado, Kelly, let's kick this thing off.
All right. Sounds good. All right. So we'll start out with what we're going to cover today. So the first thing we're going to talk about is just an example of why this can affect you. We have an example from one of our clients that came to us last year, and the prior year's return we thought was a great example to go over why the difference between a Schedule E and a Schedule C matters so much and why you can save a lot of money. We'll also talk about some of the tax information you're going to need to complete IRS forms, how to report depreciation expenses for your rental. We'll go over common mistakes, have our live Q&A, and then we'll also show you how to fill out the Schedule E and Schedule C in case you guys have any options.
Perfect. So full agenda for today. Thank you, Kelly. So really quick introductions. Why should you pay attention to us? Why should you listen to us? What's our credibility? I'm a real estate CPA. I've been doing this for 10 years. Passionate about helping people like yourselves save money on their taxes and also file accurate returns.
Awesome. My name's Kelly. I am an enrolled agent that focuses solely on real estate. Like you guys, I'm a real estate investor myself, and I have 2 properties, and I've been with Digby for almost 2 years now.
Okay, perfect. Kelly, unfortunately, we have a couple of words from our lawyers here, from what I understand. They want us to read this. So bear with us for another 30 seconds, then we're going to dive into the meat and start providing some real value. Go for it, Kelly.
All right. So just as a disclaimer, this presentation is provided for illustrative purposes only. It does not provide personal tax, legal, financial, or other professional advice. Your situation may be different. Consult a professional for information concerning your individual taxes, finance, or legal situation before taking action. All right. So first up, why should you guys care about the difference between a Schedule E and how to correctly file? So we have a pretty good example from just last year that we'll go into that kind of highlights these differences. So slide. All right, so Jessica came to us last year. She'd used this self-service filing platform in 2022 and then came to us in 2023. She had one rental property that brought in a total of $300K in income from across her portfolio. She had expenses of $100K and then filed on a Schedule C instead of on the Schedule E, which probably doesn't sound like it's that big of a deal. But as we move on to the next slide, we'll show you exactly why. So the difference between a Schedule E and a Schedule C for investors, using the information that we just broke down, is at 15.3 self-employment taxes. So in Jessica's case, she ended up paying $30.6 thousand in tax, more than she needed to. And if she would have filed on the Schedule E, she wouldn't have been subjected to that self-employment tax, and that move alone could have saved her over $30,000. All right. So there's multiple ways that real estate investors file. The first one is a Schedule E, and that's going to be the most common form of filing for real estate investors when they're reporting their portfolio. We also have the Schedule C, which we'll cover as well and go into detail. There's two other forms we're not going to cover today. One's going to be the Form 1065 and the 1120. Both of those are important. Both of those can be used by real estate professionals, but for the sake of time, we're not going to get into those today. All right, so other important information that investors need to be aware of is the filing deadlines. It might sound silly, but it's something that we actually do see investors be completely unaware of. And that is the investment deadlines for both the Schedule E and the Schedule C is April 15th. And that is for the 2024 tax year. And if anybody's interested, that is on a Tuesday. So in case you're busy that day. All right, so now let's go ahead and move over into the pros and cons of Schedule E versus Schedule C. So when we're looking at the Schedule C, the reason this is going to be used is it's most common form for small businesses that are reporting business income. So I highlight business income as this usually isn't going to be the place that we report short-term rentals. There are a couple of situations where it can be reported, which I'll get into in a couple slides. So if you're reporting on a Schedule C, it's probably because you're an independent contractor, business owner, freelance worker, sole proprietor, or a 1099. So if you're a short-term rental with what's called substantial services, that's when you'd go ahead and file on that Schedule C. So then we'll go into substantial services and exactly what that is. But the rule of thumb is if you have income coming in that's not being reported on a W-2, such as from a side hustle that you might have, maybe it's a YouTube channel, that could end up going on a Schedule C, and I would recommend talking to a tax professional if you have a requirement to file on that Schedule C. All right, so the substantial services that we talked about in the form above this, they're just going to be for exactly that, extra services that you're providing as a host to your clients. So maybe there's a guided excursion that you lead. We'll say you have a beachfront property. You lead them on a beach. You have tours. You might do maid service, turn down service, concierge services where they can call you, or something like a bed and breakfast where you're supplying meals for the guest on a daily basis, or even special services such as picking the guest up from the airport and dropping them off. And in this situation, we're going to think the difference between a hotel and a motel, where one is providing just that extra level of service and detail, where the other one, they're kind of checking themselves in, and those services aren't provided.
Yeah, so just point out also, Cal, so all good points. This is generally rare for the typical short-term rental, right? It's more hotels, motels, those kinds of things that are offering these services. That's why if you're offering them, you're probably going to need to report your income in a similar way to a hotel or motel, probably on Schedule C, but it depends on your situation.
Yes, absolutely. Thanks for pointing that out. All right, so let's go into the Schedule E now and kind of what the Schedule E does. So the difference between the Schedule E and the Schedule C is the Schedule E reports supplemental income. So the idea being this probably isn't your main job, and this might be more of an investment portfolio. So this is going to apply for S corporations, single member LLCs, trust, estates, and partnerships or pass-through entities. And this is where you're going to report your profits or losses from that portfolio to the IRS. All right, so what are some of the drawbacks of the Schedule C? And we talked about it in Jessica's case at the beginning of the presentation. The main one's going to be that 15.3 self-employment tax. And this is mandatory and there's no way to get around it. So that is going to be the greatest drawback. So if you have a profit of $100,000, automatically you're going to owe $15,000 in taxes. And I think we all got into real estate investment to make money. So we want to avoid that as much as possible. All right, next up, we're going to cover the information that you're going to need to complete the IRS forms. So this might sound pretty basic, Sean, but I think we can both agree that we've seen a lot of clients come to us without this information, and it's led to delays in getting their returns sent back to them, getting reviewed, and at the end of the day, getting their refunds back.
Yeah, 100% agree. This stuff sounds super simple. The reality is if you're not tracking your income, expenses across your rental properties throughout the year, come January to April when you're going to file, it's a lot of work to try to go back retrospectively, pull all this information together, track your participation hours, so on and so forth. So it's a good thing to start thinking about now, kind of middle of the year. But obviously at the end of the year, this is the information that you're going to need. So for the obvious things are like rental addresses for the properties, what type of property is short-term, long-term, summaries of the rental income expenses, the 1099s, the 1098s from your mortgage statements or your interest payments, the place of service date, depreciation schedules. And something that you might not be aware of is that if you changed CPAs, you probably need those prior year returns, right? Those prior year returns have losses that might have been carried forward into future tax years. And if you don't have those statements, if you don't have those prior year tax returns, those might get lost in the transition. So really important that you make sure you have those carry forward losses and the prior year return information. Something that I think is really important, obviously, is the income and expenses that you need to be tracking for the properties. Here are a lot of the income and expenses that are deductible on your rental property. Most of these are cash basis, meaning that when the cash comes out of your bank account between January and December, you're going to include them on your tax return for that tax year. The only one that isn't is this depreciation expense. And Kelly, I think this is one that we get a lot of questions on, isn't it?
Yeah, I totally agree. So I think it's kind of difficult to explain from an investor point of view what a paper expense is, which is more of an accounting term that's thrown around a lot. So when
go ahead.
When we're looking at all of these expenses, I think when we look at something like cleaning fees, it's a cash expense. I hire a cleaning team to come in and clean my short-term rental. That's just cash coming out of my bank account. So the expense is actually really obvious. And if we do have one of our clients come in, use that building and then give us some rent for it, that's obviously an expense going into our account. Whereas depreciation is different. And the reason we call it a paper expense is it's not actually money coming in and out of that account. It's only on paper. And that property is going to end up being depreciated over a set amount of time. And then I'll jump it back in a little bit later on and talk more about depreciation.
Yes, this is a non-cash item. We'll talk a bit more about it in detail at a later stage. Thanks for that, Kelly. So now we talked a bit about Schedule E. We talked a bit about Schedule C. You have probably never looked at either of these forms. You wouldn't be the first. You'd be amazed at how many taxpayers actually don't look at their tax return, right? So if you file with a CPA, I would imagine you don't open your tax return and look through it in detail. Or if you file through a self-service platform, you also probably have never looked at your tax return. So this might be interesting to you, might be super boring, but if you look at the forms, it will give you the really important key information that's necessary for you to kind of understand how the taxes work on your rental property, but also to file, right? Even if you're going to file through a self-service platform or through a real estate CPA, I still feel like this is helpful information. We might be debating on that or not, but I'm going to dive into these and actually fill these out for you. Before I do that, I'm just going to point out that these rental property income and expenses, we actually have a list for you here in our blog. So if you go to our website, you go to our blog, we have more detail that explains each and every one of those expenses that we have listed there in more detail if you're curious what falls into those different categories. So without further ado, I'm going to dive in and fill out this Schedule C in real time for you. It's going to be super exciting. So I just Googled the IRS Schedule C here. I'm going to grab this form that comes up at the top, and we're going to fill this out together. Cal, is that big enough for you on your side? You see it?
Yeah, everything's showing up. I think we'll be good on that.
Sounds good. So this, we'll say this is a tax return for Mary Stewart. She has a short-term rental, and as Kelly pointed out, substantial services. Otherwise, it would be reported on a Schedule E. So let's imagine that Mary has a rental property. She has substantial services, so she needs to report this rental income on her Schedule C for her short-term rental. So we're going to fill out, her name is going to show up here, her social security number. And then, of course, if it had a different business name, we would include that here. The type of business that it is, we're going to say real estate rental. Okay. And then down here, if the address is different than your personal, for the business, you're going to fill that in. Much like material participation that you hear a lot of real estate investors talk about and real estate CPAs, whether this is a small business or a rental, you still need to materially participate as well to be able to utilize these losses. And so in this case, we need to answer this question, yes or no. So we're to say Mary did participate. If you had any 1099s, you would have to issue those. So we just say yes. And then we'll say that she didn't make any estimated payments here. Okay. Perfect. Then any rental income that we have coming in from the business. So this gross receipts, we would fill that in. So let's imagine that Mary made $100,000 from her short-term rental. This is a very lucrative short-term rental that Mary owns, probably near Disneyland or something like that. If we had any refunds, we would also deduct those here. So if a guest was, to book and stay, that would show up here in our gross receipts. But if we refunded it, we need to take it out down here. And of course, you can look at your short-term rental platform, and we'll have this information broken out in detail in a report. Now go down here. And of course, when you're doing this with your real estate CPA or on software, this is going to happen live in real time. We're filling this out manually. So now we have 99,500 here. And as a result, our gross income is going to be 99,500. We're now going to look at the expenses that are deductible, right? So we've got advertising, car, commissions, fees, so on and so forth. Not surprisingly, these look kind of similar to some of the expenses that we have listed here, right? These are specific to rental properties. And so when we're looking at the Schedule C here, these are also tailored to small businesses. So some of the expenses that you're seeing here might not be relevant to you. So we would fill out our expenses here. For our short-term rental, we probably have some mortgage interest. So let's just say $10,000 in mortgage interest. We'll then total up all of these expenses, and then we're going to deduct them from our rental income. So here's our total expenses. We'll deduct them from our rental income here. And then we're going to, in this example, end up with 89,500. And so then this would then get carried forward into our personal income tax return. And then we would have to calculate the taxes on it. So that's how the Schedule C gets completed for a short-term rental. Now obviously this is a simpler example, but hopefully this was helpful. Kelly, what do you think?
I think it's helpful. I think for me, one of the things that was really helpful is going from the forms and seeing those very specific categories, and then seeing how they're deducted from my own personal business expenses. And that helped me to track my properties better just by knowing what I was going to have to report at the end of the year.
Yeah, 100% agree. So that was Schedule C, really exciting. Now we're going to go on to Schedule E, and we're going to talk about how to complete the Schedule E. Once again, I'm going to flash those income and expenses here. and then we're going to switch over to the Schedule E. I just Googled IRS Schedule E. We're going to open that up, and we're going to fill it out. Okay, so here we are here on IRS Schedule E. This is also Mary's. So Mary has a long-term rental that doesn't offer substantial services, so she needs to also complete her Schedule E. So Mary, this is her Social Security number. Now, it's asking if she made any estimated payments or payments to 1099, contractors, so on and so forth. So we'll just say yes to those. We'll then need to enter the addresses of our rental property. So this is important. This is not your personal address. This is the address of the rental property. And these columns, column A, B, C, they correspond to, these rows correspond to the columns here, A, B, C. So let's fill this out. 123 Main Street. And I'm going to say California. And then we're going to say SF, California.
And just to be clear, so we would fill out forms, rows A, B, and C if we had 3 properties, correct?
Correct. Yes. If you had multiple properties, you just continue to fill out these rows for each of the properties. If you had more than 3 properties, we would have to use another page in that case. All right. So then we're going to say what type of property this is. So as I already mentioned, this is a long-term rental for Mary. Let's say that it's a multifamily. So we're going to put a 2 in here to correspond to our row A here. And then for column A, we're going to fill in all of the income and expenses. So for Mary's long-term rental, it doesn't do as well as her short-term rental. She has $30,000 in income, rental income here. She has some expenses. These are all the expenses. And if the category doesn't show up, we put them in other. So similarly, let's just say we have mortgage interest of $10,000, right? So $10,000 mortgage interest. We would then deduct this from the $30,000 in rental income along with all these other expenses. So this would be a total of 10K. And we'd end up with our net taxable income from our rental here, or a loss. So in this case, Mary made $20,000. If it was a loss, we'd then have to decide whether or not that loss is allowed or unallowed. So if there's a limitation. So for long-term rentals, as most of you know, you make more than 150K per year, and you would be unable to deduct that loss. This is the form that kind of helps you evaluate that. We're not going to go into that in this webinar. That will be for a later webinar or a masterclass. If you're more interested in that, feel free to reach out, and we'll be happy to kind of send you more information or walk you through it. So this is it for the Schedule E. Again, I know, really exciting stuff, but if this is your first time really seeing the tax forms, might also be interesting and exciting as you kind of think about filing for the first time. Okay, so we went through the Schedule E, we went through the Schedule C. I'm just going to quickly walk you through how this software, Digby, will make it a lot easier to do all of these tasks that we've been talking about and actually file your tax return. So you can very quickly add your real estate portfolio here to Digby. Right? So here's the portfolio. We track whether it's short-term or long-term. You can then very simply link your financial accounts here and then automatically pull in all of the income and expenses by property, right? And so the other reason why you'd want to do this is when you do this, it's going to automatically categorize the income and expenses according to real estate specific categories. As you can see here, if we wanted to change it though, we could very easily do that here and also move it between rental properties. So that takes a lot of the pain out of getting all of your financial information organized across the portfolio, not just for filing, but for understanding a bit more about your investment property. We also have reporting. Once you've done that, we can then basically just send you a folder. You'll drag and drop your other tax documents into there. We'll have the financials. We then meet with you one-on-one. We'd review the tax return together, answer any questions that you have, and we could submit the tax return. So that's how much easier it could be, rather than doing a lot of this stuff manually. Now, especially if you're filling out the forms manually, right? Like this would be a lot simpler. Perfect. So the one thing that we didn't talk about is depreciation expense. And so what I would say is this seems to be a really confusing subject for a lot of real estate investors. Uh, and I think it's because this isn't something that's taught in school. It's not cash coming in out of your bank account, but you can use it as an expense on your Schedule E. And let me show you where that is. See this line here? Depreciation expense Schedule E. Now, we know that this is confusing. We're going to walk you through it. But because this is such a confusing, painful thing for real estate investors to do, we also built this into Digby. Right, so let me show you quickly what that looks like. When you enter an expense here, we give you the ability to be able to then depreciate that, right? So if it's a capital expense, so something that needs to be depreciated like the building, you can then add the depreciation schedule here. So people always want to know which one to use. I'm going to go into that now. Okay, so when you have an expense that needs to be depreciated or qualifies to be depreciated, it's usually something that is not going to last. It's an expense that's going to last from the thing that you bought is going to last more than 1 year, right? So unlike a utility, let's say you pay your utility bill for 1 month, that only lasts 1 month. If you go out and buy a piece of furniture, it's very likely that piece of furniture is going to last for more than 1 year. And so you need to phase the expense of that furniture in line with the income that's coming in, right? To accommodate, that expense. And so the IRS assigns a standard useful life to depreciation in order to determine how long you need to spread the cost over. Kelly, I think you said you wanted to talk a bit more about this last time I brought it up. Do you want to talk a bit more about how to assign a useful life, what the standard useful life is?
Yeah. So the way I see it is when we look at the property, the IRS is going to give a standard life to it. So one way to think about it is the roof is going to last a certain amount of time, and then it's going to need to be replaced. And with that, the IRS is going to agree. Now, what can be a little bit confusing is based on the type of property you have, such as a long-term rental versus a commercial property, it's going to have a different rate. So when we're looking at long-term rentals, the standard rate that the IRS assigns is 27.5 years. So in our case, let's say we got a brand new roof. This is a long-term rental. Since we're still on Mary Stewart, we would just assign that 27.5 year rental period. And then if it was a short-term rental, it's actually going to be seen as a commercial property. So it would also be given the 39 in the same way that a commercial property would be.
Okay.
Now, if we go back to the software, one of the things that you'll notice is we actually have different rates, right? So not just 27.5 and 39 years. We have the 1, 3, 5, and 7 years. And that's because if you do something called a cost aggregation study, which is a whole nother set of webinars that we've done in the past, we can actually accelerate this depreciation. And it's a great way to get a bigger return on your tax refund. So if that's something you're interested in, feel free to reach out to us. We also work very closely with a couple great cost ag companies. So reach out if you have any questions on that.
Yeah, perfect. Thanks for explaining that, Kelly. Sometimes when I explain it, I make it sound too accountancy, too tax professional-ish. So thanks for breaking it down. So this is more technical. Like when you first place something in service, right? When you place the property in service or the asset in service, like a piece of furniture, that means when you start using it for the property, it's going to show up on your tax return in that year on the form 4562. It only shows up once. Most people are unaware of this. And so when they leave their accountant or change their accountant, they don't realize that all of the depreciation that was placed in service in previous years isn't broken down into detail. So as a result, it just shows up as a lump sum number here. And the next CPA or self-service software isn't going to really know what went into that, like and what the schedules are. So if you do leave your self-service filing solution or your current CPA, make sure that you get these depreciation schedules as part of the tax return, your prior year return as you move on. It's not usually included standard. Okay, helpful to have these depreciation schedules in our software. It doesn't just make our life easier when we're helping people file their returns. It also makes our customers' lives easier as well as they're planning during the year, but also looking for reports in order to report this in other places. Okay, Kelly, we've had some questions flowing in here, and I was going to leave this one to the end, but since we're on it right now, it looks like Karen had a question. Uh, we've been saying, like, I didn't even realize this, but we've been saying placed in service date, and we didn't explain what that is. I don't think that's a normal term used on a day-to-day basis. So thanks for asking the question, Karen. Kel, can you break down what a placed in service date is?
Yeah, absolutely. So when we're looking at place and service dates, according to the IRS, we can start depreciating or deducting expenses after the property has been placed in service. And what that means is when it's available to rent. So I'll highlight one thing specifically, and that's we don't actually have to have a tenant in that property. It just has to be ready for a tenant. So if we list that property, we'll say in September, it's on a website, ready to be moved in, but nobody moves in until December, we can actually start deducting those expenses starting in September when it was ready. Does that make sense, Joe?
Yeah, absolutely. Yeah, and I just point you to this good answer, Cal, and I'll just point you to this blog post we have where we break down, we give you this reference to this IRS material and what Kelly already said, which is when the property is ready and available to rent, not necessarily when you have a tenant. For a long-term rental, it might take you a couple months, right, to find that tenant on apartments.com or whatever. You can start depreciating and deducting the expenses after you've listed it, looking for tenants, not necessarily when you have a tenant move in. There seems to be a lot of confusion around this, so I'm glad you broke it down so clearly, Kelly.
Yep.
Okay. So Karen, hopefully that answered your question. If not, obviously feel free to reach out and we'll be happy to provide some more context on what placed in service date means in relation to depreciation. Now we're going to move on to common mistakes that we see as we're working with our customers who are filing with a rental income, particularly around Schedule E and Schedule C. As Kelly mentioned early in the presentation, we're not talking about LLCs and S corps and that kind of stuff, at least in this webinar. We're mainly focused on people who are reporting their rental income and expenses on their IRS Schedule C and Schedule E. So common mistakes that we see, and I would say we've been doing this for a long time. We see a lot of mistakes made by other CPAs who, and tax professionals who don't have a background in accounting, or people who are reporting their rental income and expenses on a self-service platform and finally decided that it's become too much, for them to be doing it on their own. So first one, let's just run through a couple of these. We don't have to cover all of them. This one, happens a lot actually, and it could be because of what we talked about before, which is depreciation is this really weird concept for people to grasp. And so they don't take any depreciation at all, right? Like you have this investment property that you bought, you're renting it out, you place it in service, but you forget to depreciate it, or you didn't know that you needed to depreciate it.
Yeah, absolutely. Right. And I think it doesn't really sound like that big of a deal, but one, it is required. And then two, the other thing is that depreciation is actually going to be a pretty substantial chunk of money that you can use to lower your taxes. So it's honestly something we want to do aside from the fact that it's required.
Yeah, so it is required. And as Kelly pointed out, it's one of your larger expenses, right? So let's go back to this super boring Schedule E, which is now starting to become more interesting and helpful. So here's our Schedule E. Here are some of our expenses, including a bucket, for a lot of other stuff that doesn't show up here. Mortgage interest is probably one of your larger expenses, but then maybe depreciation is actually even larger than that, right? So if you're not taking your depreciation expense on an annual basis, not only are you not doing what the IRS requires, you might be missing out on some tax savings here. So this is something that you want to do. If you don't do it and then you eventually sell this property, you're still going to have to report this depreciation recapture on your tax return. And most people are unaware of that. So not only did you miss out on the benefit, you're going to have to report the depreciation recapture when you sell the property. So, okay, great. Depreciation recapture, not something we covered, in this webinar, but, obviously something that we talked about in a couple other of our webinars. So if you're not familiar with that, feel free to email us, and we're more than happy to provide more information about that. Next one, like I said, we don't have to cover all of these. I'm sure people are exhausted after sitting here or listening to us talk about tax forms and showing them tax forms. But we'll try to work through these as quickly as possible. Okay, so you took us through this example with Jessica. We obviously changed the information and the name of the taxpayer, and we also got permission before we use that example. But this is something that you definitely do not want to do, right? And to the tune of, in this example, $30,000, was it, Kelly?
Yeah,
Yeah. So this is not,
$30,000 just by
yeah,
filing. So yeah, absolutely. So if she would have filed on that Schedule E instead of a Schedule C, I think the mistake was thinking I do have another business that I'm running and not an investment property. And that led to a really costly mistake that could have been very easily avoided just by speaking with a qualified tax professional. So then I wanted to cover one of the other ones that we kind of glazed over. We were talking about depreciation, but I think
yeah.
one of the most common mistakes that we do see at Digby is people use the wrong depreciation period. And can you kind of talk about what that can result in and how that can really hurt the investor in the long run?
Yeah, 100%. So I would say with depreciation, the standard useful life that we would use for a long-term rental is 27.5 years and 39 years for a short-term rental. Most people are unaware of this. So if you're self-filing, you probably have gotten this wrong. If you're working with a CPA or tax professional who doesn't have any experience with real estate, they might also be getting this wrong. A lot of people are unaware that they need to be using this 39-year useful life period. So if you are using the wrong depreciation period, when you realize that, you should be filing a form to correct it. It's called the Form 3115. If you took the wrong depreciation period and you took too much, that's going to hurt you, and you're going to have to probably give some of that back. If you took too little, then you're not getting the tax benefits that you should be getting, and so that will be a nice surprise. If you don't realize this until you sell the property, as I already mentioned, you're going to have to pay the depreciation recapture regardless. So it's better to get this right now rather than waiting, and down the road you're going to have to eventually correct it.
Right. And I will jump in if you're kind of confused on the difference between a short-term rental and a long-term rental and what qualifies as either one. That is something that we have covered in other webinars. We also have blog posts about it. And I'm sure we're going to come back and do those same webinars again. So stick around, get on our mailing list, and then we'll make sure to reach out to you guys just so you know the difference and there's no confusion there.
Yeah, absolutely. Difference between short-term and long-term, obviously, not always obvious. So I agree with that. Thanks, Cal. Okay, I think these other questions, let's just zip through a couple. Let's see. This last one, sometimes, so we kind of talked about what expenses are deductible, and mortgage interest is one of them. Just to clarify, it's not the mortgage payment, the entire payment that you pay to your mortgage broker. It's only the interest portion of that payment will show up on your IRS Form 1098 that the mortgage provider sends you every year. That's the number that you want to use. Okay, cool. So those are there are a lot of other mistakes. These are the ones that we see, that are super common, but also just like generally helpful to point them out because they're so costly if you get it wrong. We do have time for a couple of more questions that the audience has submitted as we have been going through all of this content. Let's see. Let's just pick like maybe two, Kelly, or just even one more. I don't want to overrun too far.
Yeah, absolutely. So I have a question that came in from Mike.
Okay.
And he says he purchased property with the intent to make it a short-term rental, but didn't place the property in service. In that situation, what are the expenses that he can deduct and reduce his taxes?
Okay. Yeah. So Mike, short-term rental, didn't place it in service. you'd be unable. So as you're renovating this short-term rental, getting it ready for tenants, until you actually place the property in service using the definition that Kelly talked about earlier, you're not actually able to deduct any of those expenses in the tax year until the property has been placed in service. Once the property has been placed in service, the operational expenses, for example, the mortgage interest, utilities, so on and so forth, you can then start to take those deductions once the property is placed in service and depreciate the property. If you haven't placed the property in service in that particular tax year, you can't take any of those deductions. You would just roll them forward into a future tax year. And once the property is placed in service, you could then start to take them. So unfortunately, not if you have not placed the property in service yet in 2024 and you don't plan to before end of December, then you're going to need to take those expenses in 2025 and also the depreciation portion. Does that answer the question, Cal?
I think so. Mike, hit us up if there's any follow-up questions on that, and I'd be happy to jump on a call with you, and we'll just do it one-on-one and talk through the individual's situation.
Okay, perfect. This is a bit more complicated question. It is something that we do hear a lot. And I think that's probably because we do have a lot of newer investors that we work with. Like I said, there's a varying range of investors, larger portfolios, smaller portfolios, but for some reason, this is a question that comes up for new investors. So Kelly, I'll pose this question to you. This is like master class level. If a real estate investor is like going on Zillow, finding properties, driving out to those properties in 2024, never pulls the trigger and buys any of those properties, right? So not yet has a rental property by the end of this 2024 tax year. Would they be able to deduct the mileage, gas, costs associated with trying to get this rental property, including education? Or yeah, what could they deduct it on their tax return and benefit from the losses?
Yeah, and it's a great question, and unfortunately, it's one that we have seen too many times. The answer is going to be no. If you don't go ahead and you don't purchase one of those properties, you're not going to be able to expense what we call the startup cost of it in those research hours. So unfortunately, we're not going to be able to. Do you want to add anything to that, Sean?
Yeah, so that's 100% correct. Bad news, unfortunately. And as a result of that, any costs associated with trying to get the business started, right? So this is what Kelly called startup costs. The cap is $5K, and those costs would need to be amortized over a 15-year period of time. So even if you were to pull the trigger on one of these properties, any of the properties that you spent time trying to acquire or anything like that but didn't eventually buy, those costs cannot be deducted immediately. They're also capped at $5,000 per year. They're called startup costs. And so I would say minimize those costs, in that case, as a result of not being able to really write them off or take a tax benefit from them. So that's a tough question. And I would say let's end on that note. Hopefully everyone's still awake. Thanks so much for taking the time to thanks so much for taking the time. We really love doing these webinars and love tax forms, and we love to have people come and join us as we take you through them. So have a great rest of the day. We'll be sending out recordings of this webinar to anyone who missed it. And if you wanted a copy as well, for anyone who was able to make it, we'd be happy to provide it if you send us an email. We do a couple of these webinars, a couple of these like every couple of weeks and, a few a month. So if you'd like to attend some of our other webinars, feel free to reach out or sign up, and we'd love to see you again. Thanks for your time. Have a great rest of the day. See ya.